world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. Freddy Kelly is the founder and CEO of Kudos, a UK company redesigning the credit bureau for the modern age. Unhappy with the inaccuracy, opaqueness, and questionable data ethics of the traditional model, Kudos is using open banking, machine learning, and customer consent in an attempt to create a more transparent, more predictive credit scoring system. In addition to the insights we deliver through our podcast and newsletter, Rebank offers advisory services to fintechs, banks, and corporates. Drawing on our experience starting, running, and advising fintech businesses, and our vast network of the most impactful fintech entrepreneurs, investors, and innovators around the world, we help companies make sense of fintech, work through specific questions, and optimize proposition and strategy. For more information about our services, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome Freddy Kelly. Freddy Kelly, welcome to Rebank.
Thank you very much for having me.
Yeah, it's great to connect again. I think it's been well over a year, I would think, since we first sat down.
Yeah, a lot's changed in that time. We've got a new location. I've lost a bit more hair. All sorts.
Well, and you guys have made tremendous progress on the Kudos front.
Yeah, it's been incredibly exciting time for us. I think when we were talking just over a year ago, there was a lot of excitement around new data in credit scoring, but we were just sort of scratching the surface, and now we're 12 months into that, and there's so much going on. So a lot to talk about.
Yeah, well, you and I met up again recently on the conference circuit, I guess, and over coffee, realized there was an interesting conversation we had around credit scoring in general. I suppose in so much as credit scoring can be interesting to the layman. Certainly to people like you and me it is, but there's an FCA investigation into the way that credit scoring agencies work. There are all sorts of data implications, there are PSD2 implications, and there's a wave of fintechs, Kudos included, that are doing great work around helping people rethink the way that credit scores work, and ideally work in ways that maybe help consumers more than they help underwriters or help the credit ratings agencies themselves.
Absolutely. I mean, I often go for coffees with people and get excited about credit scoring. It's where I am. No, I mean the FCA study has really put a lot of this in focus. We've been talking for a long time about how you should own your data, and everyone kind of knows instinctively, especially since the General Data Protection Regulation, GDPR, came into effect, that we have to tick boxes and say explicitly that I want to share my data for X purpose. But there's still a lot that goes on under the hood that people don't know about. And I think a big part of what the FCA is doing at the moment is taking a real fine-tooth comb to how the industry works and how that fits in, especially with promotion of good customer outcomes and just general understanding, because it is still a black box to most people.
Well, maybe that's a great place to start. Can you run us through what the key considerations were for the FCA in terms of initiating this investigation, and what insiders like you perhaps think some of the outcomes may be?
Yeah, so there's a kind of a broad terms of reference document that was published earlier in the year that sort of outlines the purpose and scope of the study, with a kind of final report due to be released next year. What's really interesting is it's kind of quite broad-reaching in terms of thinking about how the existing model works and what the perhaps the inefficiencies are there, but then also how that model is going to change in the next 2, 3, 5, 10 years, especially with the proliferation of open data. And so I guess a good starting point might be to just sort of think about how credit scores work today. And so in the UK, although UK not dissimilar to many other markets, there are three big incumbent credit reference agencies that a lender will call upon, at least one of or more, when they're vetting your application for credit, and they'll look you up based on your name, address, and your date of birth, and then they'll pull your credit file and they'll look at the attributes in that file. Sometimes they'll look at a score, so the bureau might give them a sort of standardized number. You see these on marketing campaigns at the moment. I'm X out of 999 creditworthy, but most lenders will actually look at the raw data and they'll feed that into their own model and make a decision. But what's notable in that process is the consumer isn't really involved, right? None of that data the consumer really knows about, and none of it's kind of driven on live behavior. It's generally past credit, past borrowing, and sort of a little bit around your location, your socio-political status, and all that sort of stuff. It's ripe for disruption in the sense that there's so much more data being generated that could go into that decision.
It's funny you referenced the political piece. As a UK resident now for the past 5 years, I get mail on I wouldn't say regular basis, but a couple times a year saying register for the electoral roll and boost your credit score. And every time I go to check my credit score, it says the first thing you can do to improve your credit score is to register on the electoral roll. I can't register on the electoral roll as a result of my being a non-citizen. So even something as simple as that, it's like that's effectively impacting my ability to either access credit or the interest rate I would pay if I did, by virtue of being legally barred from registering for the electoral roll.
Yeah, it's crazy. And it's actually one of the few things you really can do if you're wanting to boost your score. The reason that address and location becomes such a key attribute is because that's the way we look people up. And I mentioned there's these three companies that do this at the moment, and one of their key differentiators is their ability to do that matching. So unlike the US market, which is where we kind of transplanted our credit risk models from, we don't have social security numbers here, right? So there's no single canonical identifier for me as an individual, and as a result we're using name, address, date of birth, as I said, and there's like 100 different ways you can well, maybe not 100, but there's quite a few different ways you can write your name and address. Am I Fred, am I Freddy, am I Frederick, is it street, is it ST, is it whatever. And so these companies invest a load of money in just matching the same person, and getting on the electoral roll gives you a really good clear signal as your current address, because it's where you want to vote, and you're unlikely to have that wrong, although people still do.
We did a fascinating episode just a couple weeks ago with a company called Centrelink out of the Bay Area, and they're solving the problem of synthetic fraud, which we went into in great detail in that conversation, but just fascinating. This is U.S. specific, but basically the shortcomings of a social security number as a way of identifying an individual, the way that credit reports are first created, and the fact that if you kind of ping the agencies often enough by just applying for credit with a fake name, eventually they create a credit report for you. Yeah. So they say, oh, we've seen this person before. And then you're kind of off and running as a fraudster, and then there are ways to enhance that, which I guess just kind of brings us back to the point of there being a number of challenges, in many cases fundamental shortcomings with the existing model. You mentioned the three main credit scoring agencies in the UK, which are Experian, Equifax, and TransUnion.
Yep.
Yeah. Okay, so you've, I think, very generally set out the lay of the land. However, I don't think we'd be here having a conversation right now if you didn't have some strong views about what does and doesn't work about the traditional credit scoring system. And quite frankly, I don't think you would have founded a company to fix it if you thought it worked well. So what are the biggest glaring issues as you see them?
Yeah, so we're building the fourth credit bureau to change the way all this works, and yeah, as you say, with good reason. There's a bunch. So I think the first thing to note is what I touched upon before, is that sort of lack of transparency, and the kind of the black box model that we're currently using means that regardless of what data are in the system, people don't really understand necessarily how they're being measured, and therefore it's very hard for them to improve, and they end up with this kind of playing this dark art of if I do this, and you see all these articles online of if I get a credit card and use 10% of the balance over 6 months and then pay it back and then do this, then I'll get a good credit score. And this is something, frankly, that the US market's much more aware of, this idea that you have to kind of massage these numbers if you want to get a mortgage or whatever. Whereas the model we see working is the one that just accurately reflects your financial health, right? And we can now do that because we have much better access to data. And I'm talking about primarily the open data movement, and specifically open banking and payment services directive 2, which came into effect in September across Europe. And so that means for any consumer, you can, with their permission, with their consent, access really granular bank history from their current account provider or their savings account provider or their credit card provider. You can consolidate that data, and you can use some really interesting machine learning methods to then form a prediction of future behavior. So rather than it being, is Will on the electoral roll? Has he stayed in the same address for 5 years? We're looking at, does he spend his money carefully, and is he saving, and is he financially resilient? All the measures that really make a difference to credit performance and whether you repay or not.
Yeah. No, because fair enough, at the end of the day, the whole point of a credit score is supposed to be a numerical reflection of your credit worthiness, i.e. your ability to take out debt and repay it, which actually has very little to do, I suppose they're correlations, but perhaps not necessarily explanatory. How long you've lived in an address, whether you're on the electoral roll, what percentage of any line of credit you happen to be using. I think what you're saying is there have to be, and there are better ways of establishing someone's willingness, ability, and likelihood to repay than triangulating based on some questionably predictive data points that you can pull on people.
Yeah, no, absolutely. And we're looking at kind of quite weak signals, I think is a good way to put it. And it gets worse when you look at other geographies. Go to sort of wider Europe, and often, I was in the Netherlands a few weeks ago, and they only recently introduced sort of positive indicators on mortgage repayments. So their credit files were only recording people had missed payments rather than had made them. And it's a totally backwards system. And the way I always think about this, if you look at like a parallel industry like insurance, it's well known to us that if I want to get health insurance, an insurer might look at my medical history, right? But typically I only go to the doctor when something's wrong, and if I'm fine, there's probably not a lot of data. Whereas we now have these things called Fitbits or Apple Watches, right? And they can look at live data on whether I'm running or going to the gym or just generally being healthy and taking however many steps is the golden amount. And that kind of signal is much stronger, and it's obviously allows those insurers to provide better products, lower prices, more sort of bespoke pricing models. And something very similar is true for financial services and credit now that we have the right data.
So we've kind of touched on the predictiveness of credit scores and how to enhance the relevance of the techniques we're using to determine creditworthiness. There's a whole other side of the credit scoring business, which is basically back alley trading in customer data. I mean, firstly, correct me if that's an unfair way of characterizing it.
I'll take your lead.
but there are. You talk about consumers not being fully aware of the way the system works. And I think it's certainly true on, how is my credit score calculated? I think it's also true in terms of banks feeding back what people would think of as, private financial information to credit bureaus who are using it to formulate credit scores, and consultations happening with credit bureaus when maybe customers aren't aware that they are.
Yeah.
So in the context of the FCA investigation, what are the tangible, 1, 2, or 3 outcomes? Are there any of these specific behaviors that you expect to be kind of highlighted by the FCA and called out as improper?
Yeah, absolutely. So there's kind of two things there. There's definitely the consumer understanding of how that data are collected and aggregated, and then there's also, from a competition perspective, the question of whether that makes it very difficult for a new entrant to the market to compete and drive competition and force those businesses to adapt. And I think both are really important questions, and both are going to be raised from the scoping document and from the terms of reference of the FCA study. So at the moment, there are these sort of closed user groups that the credit reference agencies and certain major banks and utilities companies contribute data to and receive data from. So it's kind of like you can only join the club if you put data in and take it out. And so you're kind of building this unfair advantage, if you like, for someone who's trying to build a credit reference agency, because as we know, and as we just talked about, one of the important factors in generating a credit score is knowing who someone is over a period of time and having that historical data, and also being able to match their address, which often means tracking them over 5 years, where invariably they've moved, especially if they're in a younger bracket. And so just having that critical mass of data to get started only comes from having been participating in one of these user groups for a while. And the main group is governed by SCORE, which is the Steering Committee on Reciprocity. Very catchy name. And the second piece is the consumers. Everything I just said. I think if you went to someone on the street and explained all of that, they'd have literally no idea that was going on. These numbers come from somewhere, but we're very in the dark as to where they come from. And a big part of what our business is trying to promote is, it's in your best interests to share data under your control, and you should get the best return on that data, as it is effectively your right. And that value exchange should exist between the consumer and the lender, rather than this sort of ivory tower in the background that no one really knows exists. So we're really excited about what the FCA are doing, and I think it's going to create positive outcomes for consumers and for the market in general. More competition is obviously better. There are a massive amount of lenders that we work with that aren't satisfied with the existing measures. You think about the way the market works. All these companies are trying to compete on their ability to accurately price for a certain segment of risk. They'll have their target audience that they know better than anyone else, and they'll need to, as part of their onboarding process, effectively gauge the risk of those customer pools. If everyone in the market's using exactly the same data, it's very difficult to have an edge there, and it's very difficult to see how the consumer can access different forms of credit without just paying a higher interest rate, because those lenders can't accurately interpret their risk.
To really peel it back in a way which might be helpful, what are the revenue streams for credit bureaus? And by contrast, what are the main revenue streams for a company like Credit Kudos?
So if you take one of the sort of incumbent three, you'll typically see that anything from sort of 50% down of their revenue is coming from actual credit checks. So these companies typically do a whole range of other things that don't fall under the umbrella of credit checks. So things like identity verification. They provide software platforms. So a lot of the big credit reference agencies, and this is again an element that from a competitive angle that the FCA is looking at, because if you provide the software, it's very easy for you to then sell the data on top of the software, and the sort of Internet Explorer, Microsoft Windows argument comes into play. And so, interestingly, most of the revenue doesn't necessarily come from credit checking. It comes from periphery services and a lot of consultation, a lot of modeling. So, for example, if you want to start a new lending business and enter the market, you typically are going to need some level of historical understanding to write a credit model. Otherwise, you're probably going to lose a bit of money. And some of these credit bureaus will offer you sort of anonymized data from their customer pool, and then they'll offer services around that to train a model so you can have a good foothold to get started. So there's a spectrum of different bits and pieces, but not all of it's credit checking. And obviously they provide different layers of diligence. So if you're sort of more simplistic, you might just buy a score and measure based on that score. If you're a more advanced lender, you might buy all of the underlying attributes from that score and figure out your own measure, which is what most sophisticated businesses do. In terms of how we operate, we're effectively a SaaS model, so we're charging the lenders for the checks that they put through our platform on a volume basis. We're really interested in how we can help them not just increase precision, but increase recall. So one of the really challenging elements of credit scoring is actually the people that you can't lend to. And there's the whole range of reasons that those people can't be lent to. And very often it's nothing to do with the fact that they shouldn't be lent to. It's because there's not enough data. We've talked in the past about thin file customers. So these people that haven't accrued that history. So they haven't got out that credit card and repaid it and showed that they've got a credit history. And obviously, again, people assume that their credit score is good until they make it bad, but often it's bad until they make it good. And so that's one segment that's pretty underserved. And then people that are new to the country. So with PSD2 opening up the ability to sort of score people from different geographies, and allowing lenders to serve those customers where they'd previously reject them is a huge part of our business.
And how do you guys collect the data that you use to formulate your credit scores?
So that there's two main pieces, and sort of loosely the before and after. So to get the before, which is the bank transaction data, we have a process that sits inside the application journey of a lender, and that can be on their website, it can be on their mobile app, it can be over email, telephone. It's pretty adaptable. That also fits into some of the big price comparison sites and brokers as well. That allows us to collect consent through the open banking framework and through PSD2 APIs.
So customers, as they're applying for credit, are basically initiating the creation of their own credit score.
Exactly.
By providing you access to their transaction banking data, historical transaction.
Exactly. It's entirely in control of the borrower. So it's a little bit like signing up for a new service and using your Google account rather than or paying for something with PayPal, right? You're creating this credit passport that you own.
No, that's helpful too in terms of just establishing identity.
Yeah.
Like back to some of these, the way that fraudsters game the system. I mean, if you're bringing 3 years of weekly transaction data, it's tough to spoof that,
Yeah, no, absolutely. And just, you talked about the example in the States of someone sort of creating fake identities. That there's a huge problem in the UK market at the moment around credit affordability that means that lenders are trying to find better ways to understand the income and expenditure of a customer. And typically that would be done by self-stated attributes that the customer would put into a form and say, I earn net X per month. And the same thing happens with the current products from the bureaus, that input of that signal of me saying that I earn X pounds per month is sent to the bureau, and the more times that I do it, the more confident they get that that's what I earn. And so it's as long as I lie consistently, I can pretty much say whatever I want.
It is crazy if you go into like request a credit limit increase. I think it's within a certain threshold from like an existing card that you have.
Yeah,
it's basically self-serve, right? It's like, what's your income? Are you married or single? Do you have any dependents?
Yep.
And then instant decision.
Yeah, no, it's crazy. And flipping back to the FCA, there's this is an area that they're also looking at in concurrency with the market study. So they published a document about a year ago called the Affordability Creditworthiness Occasional Paper, which basically set out.
They're awesome with names.
Yeah, it's super catchy. But this is exactly this topic. It's like, how do you holistically evaluate affordability and creditworthiness as one? Because you can be really creditworthy and not have a high income. People often correlate the two, right? As long as you are borrowing proportionately to what you earn, then you can be very creditworthy, but not have a mansion or whatever. And so how you measure those two things in tandem is really important, and especially now that there's a lot more pressure on lenders to do that with an evidence-based approach. So a lot of lenders were having to resort to collecting bank statements and documentation, pay slips from customers, which is obviously not a great customer journey. And so one of the amazing things we've been able to do with open banking and PSD2 is just automate all of that away. And just to round up the question, the second part, the sort of after piece of data comes from the lenders themselves. So if you imagine we have the before of transaction data from the customer, the borrower, we correlate that back to performance data of whether that customer repays, and the lender gives us that through our regulatory approval as a credit reference agency. And there are a few existing data structures that have become standard in the industry. So Keys, Insight, and Share are basically the names of the three databases, or the major three credit bureaus, and we kind of replicate those formats and take that data from our customers. And by having those two things stitched together, we have this really key insight that no one else has of here's Will's bank transaction data 2 years prior to him applying for this loan, and then here's how he goes on to repay it. And obviously, as you know, you can then use machine learning to predict one thing from the other. And when we get a new customer coming through our doors, what we're effectively doing is correlating how much they look like previous customers on the system at an anonymous level, and saying, based on that, this is the likelihood of repaying.
So you mentioned PSD2 there as an important way of helping you very quickly grab a few years of historical transaction data. What other implications are there for PSD2 in credit scoring?
So open data as a whole is huge. So if you look at the UK standard, open banking capital O, capital B. There's a lot of talk now that that's more or less been delivered in terms of what the CMA set out in the retail banking investigation. They're looking at broadening that out. So why don't we have utilities, telcos, other types of data, insurance, mortgages included in the spec, and use this consent mechanism to allow consumers to share that data too. And that's enormous. There's no reason why all these other financial institutions shouldn't also be required to hold the same standards in terms of allowing data to be portable, and that's certainly something that GDPR is forced a hand of in terms of the right to portability. So I see no reason that people won't aggregate and share all of their data across all of their financial products and bundle that together to make a more holistic, accurate credit score. And certainly when you look further afield, that kind of stuff's happening. There's been a lot of talk when you look at alternative credit scoring writ large of things that creep people out. So like social media data and sort of data that is quite personal to individuals. And although there's been some good applications of that data coming out, it's something we're still quite hesitant about. So there was a really, slightly terrifying, slightly amusing story in the US a couple of years ago of someone running a pilot with sort of social credit scoring and finding that people were sort of deleting Facebook friends because they thought that they were like bringing their perceived creditworthiness down and all kinds of unsavory stuff like that. So I think I'm less bullish on the sort of social media scoring. I think it's interesting for the identity conundrum that you touched on before, because it's quite difficult to kind of fake a real social media profile, although not impossible. And there's a bunch of other bits of data. So you think about how you enrich some of this information. So for example, if you're looking at a set of bank transactions from PSD2, one thing you might want to do is accurately tag those transactions as to what they are. And there's a bunch of ways you can do that. And a lot of our proprietary tech is involved in solving that problem. But if you also say, like a Monzo or a Starling, or name your challenger bank or even incumbent, have an app on your phone, then you can take geolocation data at the same time, right? And you can say, well, Freddie spent 20 quid at wherever on Tuesday at 5 p.m. and his geolocation coordinates at that time were whatever. And then you could look at the Google knowledge graph and you can see what retailer is in that location at that time, and you can do some fuzzy matching and you can get more accuracy on your classification. So there are ways at which stitching this data together also creates something that's greater than the sum of its parts. Yeah,
I mean, it gets philosophical pretty quickly, especially when you put it like that, because it's kind of like at the end of the day, what's the goal of credit reference agencies? Is it to ensure precision around credit worthiness? Because China, for instance, has an approach to credit scoring, more on the social end than, well, I suppose as much on the social end as on the financial end. That's kind of a model that doesn't sit very well with most of us in the West, because there's some concerns about freedom and liberty and various other things, all the 1984 references and whatnot. So how do you think about the role of a credit kudos or a credit reference agency in helping solve the problem of access to credit, getting good detailed information around credit worthiness without overstepping what feels like the right side of morality?
Yeah, it's super interesting, and that there's so many issues there that are sort of woven up, and we haven't touched on sort of fairness and removing bias from modeling, for example, which is a huge question as we get more data. The thing that I think about is like credit means trust ultimately, and we've got a credit scoring system at the moment that's very much set up to serve lenders and financial institutions, and arguably isn't actually very good at it anymore. What we're doing is building a credit reference agency that serves borrowers and customers, and because they're in control of their data, and we need to build a framework or a consent mechanism that allows them to use their data to get the best possible outcome. So acceptance, best rate, best comparison, best service, whatever it may be. And it allows them to do that in a secure, safe, and trustworthy way. As to what that data are and where it's coming from, I think that's a gradual shift. No one's saying that right now that all credit scores and credit bureaus don't work. But I think if you wound forward 5 years and tried to explain to someone that there's this institution or these institutions that hold all of your data that you never signed up for and sell it without you knowing about, people would probably have a question to ask about that, and it would feel odd. So I think that the transition's obvious. What we're trying to do is facilitate it in a consumer-centric way.
To what extent, the answer may be to no extent, but to what extent do you feel that, certainly Experian and Equifax, maybe TransUnion also are U.S. companies, originally U.S. companies, there's, broadly speaking, a different sense between the U.S. and Europe, certainly, many other parts of the world, around data ownership, whether it's an asset, whether it's a right, whether it sits with the lender, whether it sits with the bank, whether it sits with the customer. To what extent do you feel the existing credit scoring model, even in the UK with the incumbent bureaus, in any way inherits the US approach to what data ownership looks like, versus it just happened to grow up here because it's just traditionally been the best way of thinking about credit scoring?
Yeah, there's a bunch of factors. I think, you're right. Like fundamentally the model we have in the UK was effectively imported by Experian, and it's a transcendent of the FICO, the Fair Isaacs Corporation creditworthiness model. And yes, they're all now US owned companies. And so until last year, we had Call Credit in the UK, which was a challenger of sorts that started in the early 2000s, that was acquired by TransUnion. So we now have effectively the same three, bar FICO as well in the US, owning all of that market. There's a lot of sort of inefficiencies that I touched on before, around data matching and things that have plagued us as we've sort of transplanted that model. And I think also, if you look at consumer attitudes in the UK, we're much more skeptical about almost everything, but certainly new entrants, new challenges, and data ownership and our rights. I remember talking on a radio show about open banking back in January last year when it was being announced, and before you could even talk about the benefits, people were saying, I don't want my data to be shared, and they kind of didn't understand that it was sort of opt-in, not opt-out, and so that there's a lot of work we and other organizations have had to do to kind of say, actually, this is good for you, and it's putting you in control, because ultimately these credit bureaus are sharing your data anyway, and you don't know about it, so it's much better that you're in control of that and you can undo it later on. There are, I think, models or businesses that are more successful in the US because of that attitude to data sharing, because my data is an asset. People are it's quite clear that, once you've sold it, it can be bought and sold. It's literally, the property of whoever owns it, in essence. Whereas in Europe, in the UK, GDPR is, I think, a fantastic piece of legislation, but it's much more stringent on the ultimate right to data ownership and revocation, which asks some really interesting questions. So, for example, one of the functions of a credit bureau is to store your historical information, because if you've been bankrupt or got a negative indicator, someone needs to know about that if they're going to lend you money. And the GDPR documentation says that I have this right to be forgotten, right? So how do you reconcile me going bankrupt and then asking for the right to be forgotten? So there are definitely some challenges sort of aligning those two pieces of documentation, and that's kind of an ongoing question. But I think, I fundamentally the framework and the attitude towards data protection and data ownership in Europe means that we have much more control around who has our data and where it flows, which I think ultimately puts us in a better position to build more trust and build these types of credit bureau that don't exist.
Mm-hmm. Well, certainly in terms of protection of personal privacy, I think better structure around consumer ownership of their own data versus it just being bought and sold as a corporate asset. Totally agree with you there. What are the implications of GDPR around even the use within some of these large credit bureaus of the data that they have? Because one of the effects of GDPR that one hears referenced from time to time is, say, at a bank, right? Like, if the banks haven't done a good job designing their architectures, and often if they've inherited legacy technology, they haven't, or they haven't had the opportunity to. Maybe they have a different division in a different part of the country or a different part of Europe, and they actually can't share information from one part of the company to another. Like maybe they couldn't offer you a mortgage even though they already do your transaction banking, because for whatever reason those are two different entities, and under GDPR they can't share the information. What's the situation among credit bureaus? And this may be a long-winded way of asking, why can't I transport my credit score more easily?
Yeah, I mean, it's a good question. If you want to read it, there's quite a dry document that the three incumbents here co-authored called the Crane Credit Reference Agency Information Notice that talks about effectively how GDPR reconciles with the role of a credit reference agency. And indeed, if you look at the FCA documentation, again, don't recommend reading that unless you want to send yourself to sleep. But it kind of puts out some of these special provisions for how CRAs can store data. And certainly things like we talked about the electoral roll, like a regulated CRA has the right to access the unfiltered electoral roll, whereas other firms don't. The big question that GDPR raises for most businesses, whether they're CRAs or otherwise, is that they need to have a real clear purpose and reason for keeping hold of your data, and they need to build all the right mechanisms around how they store it, how they anonymize it, what parts they store. The best policy towards information security and with data is to not store it in the first place. And so I think a lot of organizations, this has happened now, but had to kind of really adjust how they store data, because a lot of people were storing this data and on the basis that in some time in the future it might be useful for something, which is not a valid reason. So I think it has created some challenges, and certainly around when you have these group organizations and making sure that you collect consent at the parent organization so that you can kind of share data between different units of the business is important, but they're not insurmountable problems. To be honest, it just forces sort of better data hygiene for a lot of these businesses. And yes, certainly startups have had an easier ride in implementing those things versus big incumbents, because there's no legacy and we can kind of just start with a fresh sheet of paper and do it properly. But ultimately that structure of ownership and revocation and right is good for the consumer. And to answer your question, the credit bureaus have had to put more process in place for allowing subject access requests, for example. So you used to have to pay to access your credit file, and now you can get it through a request process, but it's very manual. You get a long PDF of all your data, and eventually, obviously, that needs to be available in programmatic format as well, per the GDPR. So in principle, if it's available in programmatic format, you should be able to import that somewhere else, right, and take your data with you. It's a really interesting question. I don't think it's possible right now, but there's no reason, like I say, these three companies at the moment, no one chose them, right? They were more or less chosen by default because of whatever credit product they happened to take out when they first use a credit service. And so you should be able to shop around for your credit bureau, and I think that would be great.
Do you have any further thoughts specifically around the transportability, passporting of credit scores across geographies?
So it's something we're really excited about because of Payment Services Directive 2, PSD2. What we're doing, our model effectively works in any country that has bank APIs, which is now in principle whole of Europe. What we're able to do is customer A that comes from England who wants to take out a loan in Spain can import their bank transaction data from their UK banks and use it to demonstrate creditworthiness to their Spanish lender, for example. And that has never been possible before, and it's super exciting. So we're in the early processes of doing that. We're setting up new geographies at the moment. So we just went live in Ireland. We're looking at 5 or 6 other places right now and running projects with big banks to do that. And there are a lot of different challenges with data portability and process that you can imagine that follow with that. But now that the regulation's there, the APIs are there, it's going to be possible, and it's really exciting to be able to facilitate that.
Excellent. Well, look, Freddy, congrats on all the recent progress. Thank you for the high-level breakdown of everything that's right and wrong about credit scoring. Freddy Kelly, thank you very much for joining us today.
Thank you very much.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.